Meta's stock has dropped sharply since earnings, falling from roughly $750 to around $610. But for a company that just reported strong user growth and continued dominance in digital advertising, that move raises a real question. Has the market misunderstood what Meta is actually doing with AI? Welcome to today's Meta Deep Dive. In the most recent quarter, Meta reported revenue of just over $51 billion, up 26% year over year. That growth was led almost entirely by Meta's family of apps, Facebook, Instagram, WhatsApp, and Messenger, which continue to pull in an enormous global user base. Daily active users across the ecosystem reached 3.54 billion people. That's almost half the planet logging into Meta products every day. Advertising demand also remains strong. Meta's ad engine has quietly gotten more efficient thanks to improved ranking and targeting systems that are heavily driven by AI. However, there are two numbers in Meta's earnings that stood out to the market, and they weren't revenue or user growth. The first is capital expenditures. Meta is now spending tens of billions of dollars, more than double last year, on data centers, AI infrastructure, and custom silicon to train and run its Llama models. Management also signaled that capital expenditures will continue rising next year. This is a long-term investment in compute capacity, but in the short term, it pressures free cash flow. And the second number was the ongoing losses in Reality Labs, Meta's VR and AR division. That part of the business generated less than 1% of total revenue, but posted a loss of about $4.4 billion in the quarter. So while Meta has a moonshot here, it's still a cash drain, not a growth driver. So we have a company with massive scale, improving ad performance, and strong revenue growth, but also rising investment costs and large losses in its long-term hardware bet. And that leads to the key question of this analysis. How exactly is Meta using AI? And is that strategy something the market is correctly valuing? Meta isn't approaching AI the same way Microsoft or Google are. When Microsoft talks about AI, they point to Copilot subscriptions, Azure AI usage, and enterprise upsells. There's a clear revenue stream. When Google talks about AI, they point to Gemini inside Workspace, inside Search, and inside their cloud APIs. Again, clear monetization. Even Amazon, with AWS Bedrock and its custom inference chips, has a straightforward model. You pay to use their compute. Meta is different. Meta uses AI inside its products, not as something external that it sells to customers. Its Llama models are open source, the code is public, and rather than charging businesses to use these models, Meta is using them for one purpose: to make its platforms more effective. AI is what decides what shows up in your Instagram feed. It's what pushes certain reels viral. It's what recommends who you follow next. It's what determines which ads you see and how likely you are to click them. It's powering ranking, recommendations, and ad matching, all happening behind the scenes. So instead of AI being a new revenue stream, AI is being used to optimize the revenue machine Meta already built. The more accurate the recommendations, the longer users stay on the platform. The longer users stay on the platform, the more high-quality ad inventory Meta can sell. And because Meta has over 3.5 billion daily users, even small improvements in engagement translate into huge incremental revenue gains. This is why Meta is spending so aggressively on data centers and AI compute capacity. They're not building a cloud platform like Microsoft. They're building what they believe will be the most efficient ad delivery engine on the planet. The investment thesis is, if you can better understand user intent, better predict behavior, and better match advertisers to high-value audiences, then revenue grows without needing new products. But here's the catch, and this is the core tension in the stock. AI at Meta is not directly monetized. Unlike Microsoft or Amazon, Meta can't point to a line in the earnings report and say, here is the revenue from AI. Instead, AI shows up indirectly: stronger user retention, more video consumption, better ad performance, and therefore higher advertiser demand. To investors, that's real value, but it's not as visible or as immediate as subscription revenue from Copilot or enterprise AI contracts on AWS. And that's where the debate is. Meta is using AI to reinforce the business it already has. But the question investors are asking now is, does Meta eventually monetize Llama directly? Does Meta launch paid tools for businesses? Does WhatsApp become a platform for automated commerce? Does Meta create a subscription-based AI productivity layer for creators? Because if the answer is yes, Meta stops being just an advertising company and becomes an AI platform with a distribution advantage that no other tech company can match. More people use Meta's apps every day than use Windows, Android, iOS, Gmail, YouTube, or AWS. They already own the channels. They simply haven't turned the key yet. And if the answer is no, then Meta is just a more efficient version of what it already was. Still incredibly profitable, still dominant, but without the same upside as Microsoft or Google. Now, to be clear, using AI to improve ad performance does generate real value. So instead of looking like investment for expansion, it looks like investment for maintenance. And the market always reacts poorly to that. And this connects directly to Reality Labs, the other flashpoint in the earnings. Reality Labs is Meta's long-term bet on the future of computing. Its VR headsets, AR glasses, spatial computing interfaces. Essentially, the idea that one day people won't just scroll apps, they will interact inside immersive environments. The company still believes that augmented reality will be the successor to the smartphone. But today, Reality Labs is not that future. Today, Reality Labs is a cost center. It generated less than 1% of revenue in the quarter and lost around $4.4 billion doing it. Meta is effectively funding Reality Labs with the cash produced by the advertising business. And as long as that remains the case, the stock will continue to be valued like an ad platform, not like a diversified technology company. The positive interpretation is that Meta is laying infrastructure and computing foundations years before competitors. The negative interpretation is that Meta is spending aggressively on a market that might not mature for a decade, if ever. And that's really the debate around the stock right now. Not whether Meta is strong, it is. Not whether Meta is profitable, it is. The question is whether the scale of investment in AI infrastructure and virtual reality eventually unlocks new monetizable product lines, or whether it simply makes Meta's existing business incrementally better. Because if the future includes paid AI assistants in WhatsApp, enterprise use cases built on Llama, creator tools powered by AI, and a viable AR computing platform, then today's spending is positioning Meta to lead the next platform shift. But if those bets don't convert into new revenue streams, then Meta remains what it has been for years: the world's most efficient advertising company, with a very expensive research division attached to it. So let's talk about the risks here, because they're real, and they're part of why the stock sold off the way it did. The first major risk is regulation, particularly in Europe. Meta is already operating under the Digital Markets Act, which restricts how user data can be shared across services. And we're now seeing additional pressure in several countries considering limits on social media access for younger users. That doesn't kill the business, but it can slow user adoption, raise compliance costs, and reduce the seamless interconnectedness that makes Meta's ecosystem so powerful. The second risk is the CapEx cycle itself. Meta is committing tens of billions of dollars to AI compute, and management has openly said that spending will increase again next year. That's not optional spending. Once you build data centers, you maintain them. Once you scale training clusters, you have to keep them active. This is a commitment that reduces free cash flow in the short term. And because Meta doesn't yet monetize AI directly, investors don't see a short-term revenue offset. The third risk is concentration of revenue. No matter how sophisticated the AI gets, Meta is still overwhelmingly an advertising company, and advertising is cyclical. When the economy slows, ad budgets are often the first to get cut. Meta has lived through those cycles before, and the business is resilient, but the dependence on one revenue pillar is still there. However, with that said, the opportunity is also significant. And it comes down to something simple: distribution. Meta has more daily active users than any other digital platform in the world. More than Google's core apps. More than Apple's iMessage. More than YouTube. More than TikTok. Every day, billions of people open Meta's apps, scroll through feeds, watch video, message friends, and interact with businesses. If Meta chooses to commercialize AI directly, whether through paid business messaging tools in WhatsApp, AI-powered creator tools inside Instagram, enterprise access to Llama, or even subscription-based assistance for productivity, Meta instantly has the largest built-in adoption funnel in the industry. They don't need to acquire users. They already have them. And unlike Microsoft or Google, Meta's AI runs inside cultural behavior, the way people socialize, consume content, and communicate. That's a fundamentally stronger position than selling AI purely as a productivity tool. So the upside case is this: if Meta translates its AI infrastructure into even a modest paid layer, a few dollars per user per month, that becomes a tens of billions of dollars revenue expansion. And that's before we even talk about AR and VR becoming mainstream. Right now, the market is pricing Meta as if the business you see today is the business you'll get forever. A highly efficient, highly profitable advertising company with a large research arm attached to it. And if that's the case, the stock is more or less fairly valued where it is today. Not cheap, not expensive, just in line with expectations. But that's not the only way to look at it. If we step back and value Meta the way large cap technology businesses are typically valued, using earnings before interest, taxes, depreciation, and amortization, we get a very different picture. Meta's EBITDA is still growing at an approximately 18% annual rate over the next few years. The business is maintaining strong operating margins. And while free cash flow is temporarily compressed by CapEx, the core earnings power of the company is still increasing. When we apply the same median multiple that Meta has historically traded at and that its closest peers trade at today, we land at a fair value around $900 per share. That's roughly 40% upside from today's price levels. That upside isn't based on speculative VR adoption or a massive shift in computing. It's just based on the company executing on the trajectory it's already on, and the market recognizing that the AI investment cycle is building long-term infrastructure rather than draining capital. But, and this is important, that upside is not guaranteed. It depends on Meta eventually converting its AI infrastructure into new monetizable products. If Meta successfully does that, then a $900 stock price is not optimistic. It's just rational. If Meta never crosses that line and AI remains purely a behind-the-scenes optimization layer, then the current valuation makes sense and most of that upside never materializes. Either way, this is a company with scale, data, distribution, cash flow, and one of the strongest user networks ever built. The future is there. The execution is what determines the upside.